You're about to join Jerry Parker, Moritz Seibert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Jerry Parker, Moritz Seibert, and I, Niels Kostrup-Larsen, are delighted to be back with this week's edition of the Systematic Investor Series. And as usual, we're going to discuss last week's events in the world of rule-based investing and take some of your questions. Good morning, Jerry. Good afternoon to you, Moritz. How are you guys?
Hi, Niels. Fine.
Great.
Good. Sounds like it's a lot of energy in the air today. Interesting week again, in my opinion, although it was, of course, shortened by the holiday and Black Friday and all of those things and over Thanksgiving. But certainly I thought that there was quite a few moves still in the markets and that this general maybe level of volatility continues to be elevated, almost like it used to be back in the day before we had QE and QT and all of those things. So let me just jump into it and ask how you saw the week, what you noticed, what drives returns at the moment, et cetera, et cetera. How about you, Moritz? What did you notice this week?
More of the energies. First of all, yes, you're right. I think ever since Red October, as we coined it, volatility is back and it's continuing higher. So we no longer have those quiet days, at least in the past couple of days, where just barely things moved. There are larger moves now, which I don't mind.
Yeah.
Now I think this past week has all been about the oil markets. I mean, those moves down in WTI, they have been really large. I think we had 2 days where it's more than -5 or -6%. So really large moves. Which of course, has been a P&L driver. We haven't seen that much movement on natural gas this past week, I think. It had that large breakout to the upside a couple of weeks ago. I think we all make money from that, but gave back a little. In terms of the energies, I have a balanced portfolio there of longs and shorts, so didn't really contribute a lot to the P&L. Same goes for the bonds, some short, some long, so mixed bag here too. And not that much movement on the currencies in the last couple of days. So that has been relatively flat also. So looking back, if you sum it all up, energies and energies.
Okay, good stuff. Well, certainly on our side, we did see some moves in energies, probably, to some degree less than what we've seen in the past. Positions have been shrunk a lot, but overall, I think probably flattish performance-wise, but unleaded gas and natural gas did well, and then small losses in the other part of the complex. Commodities did well for us this week, as did softs. Some of the fixed income markets in Europe did okay, and not so in the US. So we still got mixed exposure and therefore mixed performance, probably flat in fixed income for the week. Probably a bit up in equities overall, but it's driven by, shorts in Europe for the main part, and then still a little bit long the US, which obviously trimmed overall profits in equities. But at least we made some money as equities were heading south. And then, we had a good week in currencies with the strength of the dollar. Weakness in particular in the euro did well for us. But I agree, the headlines, when you look at the screens, are definitely concentrated around the energy sector. So that was, that's what we saw. Didn't see any major trend changes per se, I would say. So nothing new to report on that side. How about you, Jerry?
Well, I concur with all of that. I'll try to think of something a little different to say.
Single stocks, anything you
single
saw there,
stocks are small net long in the single stocks. Mm-hmm. Still, the McDonald's, Coke, Pepsi, staples like that are made new breakouts a few weeks ago, and they're still long.
Coke made a new 50-week high just a few days ago, I think, actually.
So that's keeping us a little long, net long stocks, and I think the high volatility in some of the markets, of course, will cause us more or less to trade smaller. So I think these energy shorts are not as good as I would hope, because the fall kicked up almost before we got short. So that is going to make our position smaller and limit the potential for those trades, unfortunately. Possibly, I was short.
You never know.
Yeah, I was short crude in 1986, and it went to $10. So never predict how far a market can go. That's
very true.
A very big rule. Dollar strength is good. I think the big comment would be how crazy it seems to look at my portfolio, which admittedly is more long stocks probably than, since I trade the individual stocks, and not as long European bonds, because as they approach zero or go through zero, I'm not going to be long those markets. But it's just the number of shorts compared to the longs, and this is never going to be a good formula for trend following when all we can really talk about is our short commodities and short currencies. So my biggest longs would be something like the few stocks and nat gas, maybe a couple of other markets that one could define as in an uptrend, but it's not. This performance is not going to get going the way we want it to until we have 2-to-1 longs rather than I have now 2-to-1 shorts.
Sure. I think that's actually an interesting point. I mean, I think you make. I think it's a good point. I think it's a lot. It's something that maybe investors don't quite appreciate as much. That generally speaking, performance for us trend followers are better for the long trades than they are for the short trades. Even though people often associate our strategy with something that can make money on the short side in equities when they need it. But I think that's a great point, and not to discourage investors because we don't really know. I mean, that's obviously the mantra that we live by. So it could still turn out to be, some positive performance coming out of these positions. But overall, in the long run, we do tend to make more money on the long side. That's You mentioned natural gas. There are a few headlines in the news about natural gas. We're now starting to see some of the victims of recent volatility. What did you guys pick up during the week?
I think we talked maybe last week about there is such a thing as a double short nat gas ETF or ETN.
Okay.
And then that's not fun. And then this week here in Florida, where I live in Tampa, there was an article about a short a fund that sells options, and they were selling options in natural gas. And it blew up and lost all the money. And I think it was mostly managed accounts. So people lost another 20%, I think, according to the news. And that was, kind of I tweeted that 3 or 4 times. It got a lot of interest because it's sort of the opposite of what we do. The victim was on, the manager was posted a pitiful, easy to make fun of video on YouTube. And people were making fun of it, and I sort of jumped on the bandwagon, but only in the sense that I was trying to make the point of how trend following is sort of the opposite of we take small losses and have unlimited upside versus the smooth, high Sharpe ratio performance of selling an option, and it just always works. It just makes money all the time until it doesn't, or until you lose all of your money. And at least that's what I keep hearing, since I've never done it or known anybody who does it. But it did. It was another way for us trend followers who are suffering through a bad period to sort of feel superior and make fun of others, but to learn a lesson too, that maybe it's safer to trade a systematic approach with low odds of winning, low Sharpe ratio, just take our small losses and continue to play for positive outlier trends.
Yeah, I mean, it's the classical thing we've discussed a few times, right? And, investors tend to prefer what is smooth and looks safe, but I think we certainly all believe that safety is not always what it seems like. And as you say, we prefer to take the opposite of that. But I do think you bring up another interesting point, which investors should be aware of as well, and that is the unlimited liability you have if you set up a managed account. So I mean, do be careful if you go into any investment strategy via a managed account, because these are the times. They may not happen that often, but when they do happen, it can be a very painful experience. The advantage, of course, to go in a fund is that, okay, maybe you don't have as much transparency, although many managers nowadays will provide that, even if it's a fund investment. But you do have the limited liability. Of course, you pay a little bit for it, but you have a limited liability, and that is crucial when these things happen. So two kind of volatility blow-ups. I mean, in February was the VIX itself. Now we've got another market that just explodes in terms of volatility. I mean, it's certainly been the year where volatility has come back in some way.
Yes, absolutely. And natural gas is that way. I mean, just by trading that for many years, I mean, it's been relatively quiet in the past couple of years, but it's just the character of natural gas that every once in a while it just becomes completely wild. If you're short options against that, well, you need to hang in there or give up.
Yeah.
I really I read the article as well, and I was looking to get onto the website, which was, I think, taken down immediately, optionsellers.com, because I saw a tweet from Nassim Taleb who said, it's actually funny that the guy made reference to the black swan, saying it's a good idea to sell risks in the tail. So, just to flip the coin, and apparently made it sound as if Nassim Taleb had said in his book that that's the right thing to do.
Right.
But, again, selling those options, selling convexity, selling volatility, that is a very, very risky investment strategy. It's an investment strategy that produces smooth returns for a period of time, has many more winners than losers. It's kind of like that makes you feel good strategy, but it does have that risk of just failing in one sweep go. Like there's 1 day or 2 days, as it was the case with that firm, and then you're out of business, or even, owe the clearing broker more money than you put in initially. So it's just, I think we need to repeat those words. When those type of strategies are offered, I'm not saying that people must never invest in those. I mean, by all means, people should, I think, invest what they think is good for them. But that risk, always have that at the back of your head. It is substantial, even though it doesn't show up in the numbers.
Yeah.
So I tried to make a very extreme point on this. Of course, that's what I do. I take something and try to twist it to meet my philosophy. And so that's why I wrote, it's safer to trade with low odds and a low sharp. So how can this be? And it reminds me of another tweet I had, or an article I read a few weeks ago, where Cliff Asness, I believe, was making fun of somebody who had a 3 sharp ratio. And so then my point was, well, it's obviously you can make fun of a 3, but I'm wondering, should we make fun of a 1? Because what's the difference? Are we just, or if there is a big difference, let's hear it. And I'm going to make fun of both, a 3 and a 1, and I'm going to prefer the low odds and the low sharp. And then in this situation, you can definitely see, okay, I see what you're saying now. And natural gas, from our point of view, is a prime example. Once we buy that a month ago and we size it properly, now it explodes into this profitable trade, and we're making money, the opposite of this option seller, and it's highly volatile. So this sort of micro sharp in this particular investment is going to be low. It goes up, it goes crazy, it sells off, but we're golden because we have a reasonably sized position. We have the right position. We have a lot of built-in profit. So I say, forget it. Okay, so maybe you want to take a little bit off the table. That's fine, but still, is it going to be a high sharp trade? And probably not. It's the nature of hanging in there and waiting for it to become something even bigger and better which we've done all of our trading career and that we've seen to be very successful, but it's not good at sharp. And so I think that as time wears on and we forget about the option seller and this idea that as I start evaluating my systems over the next 6 months or 12 months, I know that I'll say to one of my research guys, well, what's the sharp on this? And blah, blah, blah. I'll get sucked right back into, well, I don't believe in sharp, but I'm going to talk about it. Is there anything better? But I definitely think that turn your back on vol as long as the trade or your trading is profitable is a much better strategy than sort of buying into the volatility of big profits is somehow a negative.
And I think another thing that the nat gas trade has shown us, and I know that there's always this debate every time equities fall, we get blamed for being the ones pushing it down, although they never blame us for pushing equities up, funnily enough. But in this case, the three of us were talking about this breakout in nat gas a long time ago, weeks before it happened. So we were all positioned way before the volatility came in. So if we're some kind of proxy for the trend following industry, then this had nothing to do with trend followers. And I think that more often than not, a lot of these big market moves has nothing to do with trend followers. I mean, we don't create the trends, we just get into them, and often we get into them, before the really big moves occur. Not always, but I think that's just another thing that I just wanted to put on the record, that people shouldn't always blame our industry for the bad stuff every time there's a bit of volatility coming into a market.
And it is true. I mean, in many cases you have that undercurrent, and there's things happening and developing. Small trends starting to display, and we get on for the ride. And then it just happens so that we're already positioned the right way when the big moves come. Right?
Sure. And look at energy. I mean,
best
this
example
ferocious sell-off. I mean, it's not driven by CTAs, in my opinion. Certainly not the initial part, because that would be against our philosophy. And there seems to be a lot of other things going on in that market right now. Whether it's the Saudis or the world sending a message to the Saudis, I don't know. But it seems highly interesting timing given recent events in that region. Yeah.
One more point about the Sharpe ratio. I'm not sure about how you guys actually think about that, but many years back, I had the feeling it's kind of like that bragging contest of, I have a 1 Sharpe, I have a 1.5 Sharpe, and if you didn't have a greater than 1 Sharpe, you weren't allowed to be around the table because you're kind of like bad trader, and who wants to have something that is less than 1 Sharpe. And speaking to clients, they were looking for and asking, is your Sharpe greater than 1? And if you couldn't answer that with a yes, you were kind of like, well, boring type of strategy. And then, I kind of like, it's that trap where you get in and you go like, oh, I need to have a good Sharpe, a great Sharpe, and hopefully it's going to be greater than 1. And then, in a quiet minute, when you reflect on that, I just came to the conclusion and said, well, you know what? 0.5 Sharpe, I think that's good enough. If it's 0.6, it's great. Because when you think about it, it's, 20 vol with 10 to 12% return. And it's kind of like, the 20 vol space is where I'm in. 10 to 12 return, annualized over long periods of time. That's great. That works for me. If I know that the strategy that I'm following is robust, keeps me in the game, doesn't cause me to lose all my chips, and is safe, then that's something that I'd like to play. And whether that's 0.5 Sharpe or 0.6 doesn't matter to me anymore.
No, I mean, I agree. And people forget that equities over the long run has a Sharpe of 0.4. And right now, nobody's complaining about what equity is doing. It's just whatever time window you look at.
Exactly. It had a Sharpe of, I think, around 1 or something like that. If you looked at the past 5 years, let's exclude the last couple of months, right? But ever since the financial crisis, just being long only equities, passive, had a Sharpe ratio that's been very tough to beat.
I'm sure you want to add something to this, Jerry, maybe, but it's just something that I find funny. So one of the things that I do when I meet with investors who may not be so versed or well versed in trend following and what it can do for a portfolio, I created this this chart that shows if you have a portfolio just of equities and bonds and trend following, what should the allocation be before the tech bubble or right at the bottom of the tech bubble. So the worst time, so to speak, in terms of a crisis, and the best time to invest in equities for sure. And the same with the financial crisis, just prior to the financial crisis and just in March 2009 at the bottom of the financial crisis. And I don't remember all the details, but what you see when you optimize for Sharpe in this case, just to see what's the best portfolio with the highest Sharpe had you invested at these 4 starting points. When you take the 2008 crisis, for example, the allocation to trend following, and in this case, we're using our own performance from our program, but that's pretty stable. But it's very interesting to see that prior to the crisis, you have some bonds and some equities and then trend following. But if you look at the highest Sharpe as a portfolio at the bottom of the financial crisis, you should have had no bonds whatsoever since 2009.
Yes, another great feature of trend following. It doesn't kick anything out. It first premise is, how are you going to help me markets with my volatility and risk? And it's one of the huge edges, which I mention all the time. I think it's so radical and crazy that in the systematic approach that we use, we have to assume that all the trades it's right to assume that all the trades have the same expectation, the shorts, the longs. And so even when I was trashing the idea we have too many shorts on now, because that's where the trends are, theoretically, I should not talk like that. They all have the same expectation as the longs. That's all the trades have the same expectation. So, so many great things. We'll never get to the end of how wonderful what we do is, I'm sure.
That's why we do it every week.
Yeah.
We get a new chance every week to say it.
Another thing I would add, too, is that exactly what you and Neil said, but plus the frequency of profits. I think because we have a systematic approach, and we trade a lot of different markets, sectors, and longs and shorts, we have a tendency to be frequently more profitable than trading one sector, even stocks, or just long only. So that matters to people, whether it's 0.4, 0.6, 1.0. Like I've said many times, I think when I first started in 1988, we made money 10 years in a row. And it was not always pretty, and there were some big drawdowns, and not always great years, but listen, 10 years in a row, not losing money, that goes a long way with people in the real world who are not maybe intellectually influenced by Sharpe or numbers, but in the real world, they're really like this idea of making money. And then you can cheat the Sharpe more or less, with the take profits and profit objectives or heavy lots and lots of vol targeting, that you can artificially make the Sharpe look high. And getting out of some of your nat gas after it rallied a lot, that little piece of the nat gas, for instance, if you got out at the high of any of those days, the high move, that piece of the nat gas trade has a Sharpe of infinity. You made profit and you got out at the high, no drawdown. So that's a nice contributor to your ultimate P&L in nat gas, or your ultimate P&L for the year. So it's a pretend number sometimes, depending upon if you're not always using a trend approach to your exits.
Yeah, I was in London this week, and I had to meet with a fairly sizable client of ours who had some, an interesting timing to join the trend following space, because they actually joined in February. So obviously it's a tough time to make your first entree in this industry when you pick sort of the first out of a couple of really difficult months of the year. And so I wasn't quite sure exactly how to frame the conversation when you meet with a group like that for the first time. So I found this old chart that actually Michael Covell uses with regards to Don on his website. It's a chart of our composite performance since 1974 when we started, and the S&P. And then we draw on all the drawdowns we've had of 25% and more. And prior to this year, we've actually had 12 of them. And this year, it's the 13th. And what I wanted to illustrate to this particular client was that, because obviously the headlines is, does trend following work anymore? Is it dead, et cetera, et cetera. But when you look at a chart like that, I'm sure you would have exactly the same, Jerry, in your track record. When you look at a chart like that, this 13th drawdown of that size doesn't look any different from all the other 12. And so, of course, once you see that, it's like, it's like trend following. It's like a painting. You need to look from 20 feet away. I mean, don't look at all these, swings up and down, but just look at the bigger picture, so to speak, and you'll see that the trend of the P&L curve continues to go up as you move to the right, but it's certainly not in a smooth way whatsoever. Yeah, I mean, as you said, Jerry, it's just something that we need to continue to discuss and talk about, so that people understand that this is part and parcel of what we do, and get away from this focus on the highest sharp and the smoothest return profile, because it's just a snapshot of a time frame.
I agree.
Good stuff. Yeah. Jerry, you've done some tweeting this week, I'm pretty sure. How did that go?
Well, we got into some fun topics that people enjoyed. It seemed like my 16,500 followers are not the typical traditional investors, possibly. So sure. We take joy in things that make us look smart in the midst of not a great period. We've already talked about the option selling and
sure.
that stuff. My most popular tweet, I think, this week was a article from Bloomberg about World Quant, a very large, famous hedge fund that was lost 9% in October. And then I just simply took advantage of a very something, most people would not make fun of. And without any comment, I just started listing different characteristics of this firm: 1,000 research consultants, 500 investing professionals. They say they have 120 PhDs scouring for recurring patterns, a library of 4 million alphas, soon to be 10 million. Then another quote was, soon some believe it encourages data snooping, complicated parameters to make strategy look great in the past. And so without any comment, of course, I'm making kind of fun of this and saying, well, I certainly don't have 120 PhDs, 4 million of anything, hundreds of employees, and my little trend following, price only, even if it's stocks only, which is probably what these guys were doing, long, short equities. I feel pretty good about myself that I can also lose money, maybe a little bit more or less than they are, with a lot less overhead and intensity. So we're always looking for examples of where really smart people look like us. And when we just follow the trends, or we even look better. That's even certainly a better situation when the trend, simple trend following does better than more complicated strategies. People like that. They thought that was, I think, kind of funny.
Yeah, it's funny you mentioned that because I've certainly come across that name a few times, even in the past week. And And of course, this is one of those firms that follows the path of a couple of the other really big firms in that space, where they hire all these small teams of traders and they give them, lots of money often, but with very, very tight rules for, if you lose 3%, you're out kind of thing. And so, a lot of small low vol strategies, and I'm sure they try and put these things together in a, with some view on correlation, but even, as you say, even those firms who do that to that extreme, and I'm not necessarily a big fan of it, can come up short, despite something that like this. I'm sure if they ran the simulations, this shouldn't happen, in a million years, but it does. And so like, I agree. That's an interesting topic for sure. What else did you see in the social media world this week, Jerry?
Well, I have some friends from Longboard Funds, which is a CTA managed future CTA, and they put out a really nice long piece this week, and they particularly liked some of the graphics and charts they put up. One of the conclusions they come to is, quote, "I simply do not feel comfortable knowing that my life savings will be fully exposed to a giant bet on the stock market in a traditional portfolio." But that's not nearly as funny or great as the actual chart that he puts up, which shows the average drawdown per decade of CTAs and compares that to the stock market. So it's a horrific looking chart for the stock people, of course, or I would not have tweeted it.
Of course.
And then on the far right, it shows 2010s and the decade that we're in. And there's just the smallest of drawdowns for the stocks and the CTAs. And then as compared to historically, 50, 60, 70%. And the little sign says, "You are here." I just thought that was so funny. You go to the amusement park, "You are here. Here are your directions on where do you want to go, find the restroom or whatever." So you're looking at these ridiculously large drawdowns that has, in every decade since 1900 or 1910, and you are here. It's at a little drawdown you can barely see. So I thought, but this is, I think, a little bit of contrast to Crisis Alpha. Yeah. So look, it's not a big thing. There's nothing we can, it's obvious. If you're trading currencies, commodities, stocks, bonds, not just stocks only, long and short, not just long only, with a systematic approach, it's halfway decent. It's sort of longish, medium termish, not too in and out all the time. Of course, how can you have the type of drawdowns and the risk that long only, even though the returns from the stock market are great, it's just that what sort of risk are you taking on to get those returns? And so, whoa, that sounds like Sharp. Well, not really, even though I don't want to pay attention to vol or Sharp all the time, especially with my winning trades. I definitely am interested in capital preservation, and in no circumstances would I accept an 8-ish% return on average with, really an unlimited downside. I mean, stocks won't go to zero probably, but if you're down 70 or 80 or even 50%, you're thinking, gosh, so they don't go to zero. That's really not helping me feel too good right now.
No, and I guess the last few weeks have seen some of the biggest names in the equity world take some pretty serious beating. Even though the indices may not have, fully expressed that, we know that some of the really large stocks, and we all know the names and the FANGs and whatever they're called, have taken serious amount of pain. And since they are big, a lot of investors are holding them.
He also shows another chart with the worst drawdowns of the S&P since the inception of managed futures. This was something we've talked about, how we kind of prefer this idea. How is a diversified, systematic, trend-following portfolio done? During a period of poor performance for equities, and we prefer this to Crisis Alpha. How did we do in October or January or February or in a certain particular week versus how do we handle, the extent of the whole bear market or the worst drawdowns. And so that chart looks really nice as well. And he ends with a nice quote, 35 years of equity-like returns and no correlation wins my allocation. So this is what we do. This is what we're selling. It doesn't matter, certainly to me, what happens in any one single market or what clients are saying. It's the ultimate advantage here is just risk control, safety, with still a chance to make a reasonable return.
Yeah, absolutely. Absolutely. Anything else you want to share from your top tweets this week, Jerry?
That probably wraps up all the good ones that I saw this week.
Cool. Well, we've got some questions, which is great. And by the way, to all of our listeners, we do like taking your questions, so keep them coming. We certainly enjoy this. First question today is from Brian, who have asked questions before. And he makes a bit of a comment first, and then he basically boils down to the question to the following. In a general sense, how do each of you onboard a new client with zero experience with a trend following fund? As your career has progressed, how has your onboarding process evolved? And I think he's referring to sort of what quote unquote persuasive arguments do we use in our dialogues with prospects, that allows us to turn them into clients. Do you want to take a stab at this, Moritz, at first?
Just need to say that currently I'm not onboarding any clients. I've done that in the past.
Yeah.
So maybe out of practice, I don't know. But I focus on, when speaking about trend following, and the experience and living through those markets for many, many years with trend following, it is the safest and most robust investment strategy that I've found, and I've looked at quite a few. Now there may be other firms like World Quant that look at 10 million of investment strategies. I'm not there, but I've invested pretty much my life into finding those strategies and testing things and making things work. And every time I come back to trend following as those rules are the guardian angels in volatile markets. So I like them. That's what I do. Keep you in the game. Small losses, large winners, over and over again. And that you have a strategy that takes you into markets which, as a, say, discretionary trader, you'd be very unlikely to take. Think about, the bond markets where we had 0% interest rates or even negative interest rates. And you'd say, I'm not going to be holding physical bonds at 0 or negative rates. But, I recall in the past couple of years being long bond futures at negative rates, and they made me a good amount of money. And those are so counterintuitive trades to people, but they happen in a trend following system if you let them develop. So it's very diversifying, very safe, time proven, hard to kill, maybe impossible to kill. I don't want to say impossible, but hard to kill. That's what I like about it. So come along for the ride and diversify your portfolio with that great strategy.
Yeah, absolutely. Jerry, what do you talk about in the onboarding, quote unquote, onboarding process?
Well, exactly what we do. Currencies, commodities, stocks, bonds, long, short, systematic, long-term, low cost. I like to throw that in. Unfortunately, I know that's hasn't always been the case, but now in the mutual fund, liquid alts 40 Act world, we're sort of low fixed fee, risk control. I was just thinking another thing that popped up in my head was, I think not only do we, in talking about the sharps and not sort of being okay with a low 0.4, 0.5, 0.6 sharp, I think once I eliminate that as a concern, I believe that frees me up and says, I think if we went to some of the PhDs and quants, more quant like people, and said, well, solve the problem, but without regard to a high Sharp, I don't think they would have a problem with our argument. You know, they'd say, oh, well, if you take that off the table, and we're going to sort of be freer with our profitable trades and take small losses and tilt in that direction of fat tails on the positive side, I think the puzzle becomes much easier to solve. And what we do is, I think, more reliable. Once again, frequent positive 12-month trailing returns. And so redefining the puzzle into something that is less complex, let's say. I think when some of the famous people, I think Simons has said recently, trend following doesn't work, or I think he must mean not using our metrics of a Sharp of 1 or 2 or 3. Of course, it's not going to yield that, but it continues to work, and it will work probably for a long time, as long as we're long-term enough or medium-term enough. But it's very important to let people know how we define this puzzle and this problem and how we're going to solve it.
Yeah, absolutely. Well, I mean, I think on my side, I think the way I talk to people in this quote-unquote onboarding process has certainly changed over the last 30 years. I think when I started in this industry, and for a very, very long time, I think I did what everyone else was doing, focusing on kind of the features of trend following. And I personally feel that as an industry, we've probably made it more complicated than it needed to be. So in recent years, I've changed it to maybe do it more as kind of storytelling and not focusing too much on the nitty-gritty features, and really trying to explain what the benefits are. And what it can do to a portfolio. Hence the kind of study I mentioned before, when you visualize to people what it can do, even if you pick 4 completely random type, entry points. The fact that the allocation to a trend following methodology actually doesn't change much whether you start before or after a crisis. I think to many people that's a bit of an eye opener. And it makes it easy for me to make the case that this should be a core allocation in the portfolio. You shouldn't really try and time it. If you want to switch, if you want to have some kind of an active approach to your portfolio, you should probably spend more time trying to get the allocation to bonds and equities right, because that's the one that really changes over time. So I guess I'm trying to become a little bit less technical, because I think we lose a lot of people when we do. And more focusing on benefits, and of course, willing to explain the details if people want to, and I think also acknowledging that trend following has weaknesses. I mean, we don't deal well with reversals. We don't deal well, of course, with non-trending environments, and of course, then you have to try and explain as to what your particular strategy can do to combat drawdowns during those periods, not as something that we can guarantee, but at least we can maybe address the weaknesses of what we do. So Brian, that's a little bit about the three of us, what we do in that process. So I hope that was useful. Next question comes from Mike. Mike, I actually saw a few weeks ago in Florida. He's based on the West Coast of the USA, and he sent over quite an interesting question, which I think we're going to try and do, because the question is kind of, if we could only choose one word, each of us, that kind of describes the key benefit we would associate with trend following, which one would we choose, and could we do it describe it in less than a minute? So that's what we're going to try and do. It's just to let you know, Mike, it's unrehearsed. So we're just going to do our best here. And I'm happy to kick it off. So the word I would focus on, Mike, in this case, as a key benefit is really discipline. I mean, I think with trend following, the discipline that it comes with having something where you follow rules and where you don't let your emotions dictate what you're going to do as an investor, I think that is a incredibly important benefit to any investment portfolio, even as a source of diversification. What I mean by that is, I think to have part of your portfolio managed in this way, let alone which markets we trade, the fact that we can be long, short, and all of those things, but just the fact that you have part of your portfolio that is traded in an unemotional way and with full discipline, I think that adds a tremendous amount of discipline. So if I could only choose one word to describe the benefit of trend following, Mike, I would go with discipline. I'm going to turn it over to you, Moritz. See what word you chose.
Yeah, great. Thanks, Niels. You're right. I mean, discipline is a great edge in the way we trade. Now, deep philosophical question here, really. Thinking about that, I think I'd come up with capital preservation. I've mentioned that repeatedly, but it is a feature that I really love about a trend following trading system. You throw a lot of darts against the wall, you see what sticks, and then you run with that, what sticks. And if it doesn't stick, you get out with a small loss. So that distribution of trades, it's never going to be a large loss, or at least it should never really be a large loss unless there's some massive gap in the market. But that keeps you in the game. We do it over and over again, long run, taking small bets, many different markets, long and short. That's the way to go.
Great word. Jerry, you've got the last pick. So which magic word would you choose when it comes to describing trend following?
I don't want my 30 seconds to start yet. So I'll let you know when it starts, but or minute, whatever he said. But I do think it's everything we do does revolve around safety and risk control, and at the same time, wading into these treacherous markets with appropriate leverage and approach that still gives us a chance to make a reasonable return. But and certainly a key part of that is the diversification piece. The currencies, commodities, stocks, bonds, long and short. Shorts are very important to diversify and to reduce our portfolio risk. One of the things that's unique about systematic trend following is that it is a safe way to get all of these markets into the portfolio, because buy and hold is not going to work in maybe anything other than the stocks. Is it going to continue in the stocks? Who knows, but it always has, so let's assume that it will, but not the commodities or the currencies. So, and then not only do we get them in there in a risk control manner, they can add to performance. So it's not just adding a commodity or real estate or cryptos or whatever to your portfolio to smooth out the stock. The returns are going to be dominated by the stock market. These other markets, with our approach, is actually going to have a positive contribution over time to performance and, of course, volatility. I did listen to another and tweet another video this week of a big CTA in Europe, and the way she described our strategy versus discretionary macro is lots of positions with little conviction. We have very little conviction on these trades, these markets, which is good. We're not looking at 5 positions that our life depends on it. Our reputation depends. And of course, we're going to make money only when those trades do well, and we're going to be very happy and thankful for those trades. But our lack of conviction, I think, really is just, oh yeah, I'll throw that trade away if it goes down X% and my small loss predetermined small loss gets hit, it's gone. I have no love and conviction and or emotional investment in this trade. And you know what? If it goes back up, I'll have to get right back in. I'll get back in, no problem. So to some degree, this keeps us out of trouble emotionally and strategically.
Absolutely. I take it your 30 seconds has started by now.
Yes,
Jerry,
sorry.
So,
and ended.
Yeah. Ended. Okay, cool. Great question, Mike. Thanks so much. We really appreciate it. And since last week, I was sending out a little bit of alert in our conversation for questions from investors. George has taken us up on that, and he sent over 3 questions that are more from an investor point of view, which we highly appreciate, George. So thanks so much. So here we go. Trend following basics seem clear to those who choose to pay attention. As you've mentioned on prior episodes, most of the turtle rules are in the public domain. You've also, and this was actually a tweet sent to Jerry, that's why it's referring to the turtles. You've also said, follow the rules. With a marginal programmer investment, I could likely design my own system. Short of outsourced day-to-day management, why should I hire an external manager versus develop an in-house trend following program, especially if I was a well-capitalized institution? Great question, George. I'm going to send it over to Jerry first to comment on that.
Well, I'm not exactly sure what a well-capitalized institution, what point he's trying to make there, but...
Well, just if you had enough money to hire a programmer to, I think program the rules and all of that. So it wasn't an issue to do that part of it. Yeah.
Because I think my answer sort of would insinuate that what he was meaning is that it doesn't have to be so good as yours with 35 years or 25 years of experience, because I'm highly capitalized. So I'm not going to be as good. I'll lose money. So I think that's the biggest reality, is that like any business or any service or product, it can be sort of defined as a commodity. I know the basics. Why should I want more or something? And almost deny that there could be anything better. And certainly the 3 of us have been around a while, and we are better now than we've ever been. We have a little bit more in our toolkit and our trend following toolkit. And so we need to compete and to stay near the top where we want to be. So in 35 years, George, you'll have more as well. And the George in 35 years will look back and say, oh yeah, why should you hire the George of 35 years later? Well, because I know a little bit more, and it can make a difference. And that's the same with every industry, every product or service. It can be somewhat of a commodity, or everyone kind of knows how to do something, and yet some people can do it a little bit better, and it's worth the cost. So that's, in my opinion, sort of in a nutshell. But the downside is it may take a long time, years and years, for you to be able to say, oh, okay, I see now that these things you kept talking about that seemed minor actually do play out in life and in the markets to be worthwhile.
Yeah. No, I mean, I think from my point of view, I would say I concur what you say, but I don't think that you can really substitute experience in this industry. And it sounds odd because a lot of people, I'm sure, think that, well, when you use a rule-based approach, you can just simply hire some clever programmers. They can, essentially create a number of different approaches and backtest it, and you'll pick a few of the best ones and off you go. The thing is that I think you really need, I'll say that again, you really do need real experience to deal with the difficult situations, just like the chart that I described earlier in our conversation, where we at Dunn have had 13 times drawdowns of 25% in our fully leveraged program since 1974. I mean, each of those times would have felt pretty miserable, and probably you would have questioned whether your systems were working, et cetera. And so anyone coming into this industry, as soon as they run into their first really large drawdown, how they react at that time, the changes they may or may not make at that time, is going to be crucial in determining the future success of your system. And even though we have not made a lot of changes over the 44 years we've been in business, the changes we have made, we believe, have made a significant improvement. And those changes can only be made from, having experience with what we do, and not just data mining the hell out of the data we can get our hands on. So I truly believe that this is something that is underestimated by many people, because there is part of our industry is arguing that this is a commodity and you don't have to pay very much for it. I disagree. And also, I mean, there are obviously ways nowadays where you can find managers that predominantly shares in the upside of the client, and I really don't see why that is a bad thing. And whether you pay 0% management fee, 1%, that shouldn't be a deterrent. If people are mainly compensated by the success that they provide and value they provide, investors shouldn't be concerned about outsourcing it, in my opinion. Moritz, what are your thoughts?
You said so many good things. Difficult to add to those. Sure.
That's fine. I can give you the next question if you want. There are three of them. But, yeah.
I mean, just a little anecdote there. I think it really has to do with experience. When I, look back more than 20 years ago, when I, started reading all those books, trading books, I don't think the trend following rules were public back then. So I didn't have access to those. But if you had, hired me to program a trading system for an institution so that they can internalize their trading, it would have been a disaster, because you lack the experience and you come up with trading rules that look great on paper, look great in Excel, but have no meaning and no heartbeat in them in the real markets. So it is that journey of going through different markets, taking on risk, experiencing those markets, and over the years, with your own money, with investors' money, becoming a better trader and just better at that business. And I still think, even today, that journey isn't over. I think I'm still on that journey where I'm becoming a better trader. I don't think it should ever stop. When I make changes to systems, I mean, many times I test things and they look good historically, but then I go like, nah, I'm not going to implement that because it's kind of like against my philosophy here, or against what I really want that trading system to do. So I'm just going to throw that away, even though it may have provided a little bit of better return in the past. And I wouldn't have done that 20 years ago. Just no way. So experience is super important, and to work with managers that have seen those markets and have experience designing and trading quant systems, systematic systems for many, many years. That's just nothing that you could just put into a programmer out of college and say, program that system and run it. I don't think that's going to work.
Sure. That's such a good point. I a few years ago started coming up with a list comparing myself to what I was reading about other traders and trend followers, and I started a list of things that I refuse to do. So it's not just the experience of creating, it's the experience of learning what to limit yourself. And
yes,
this particular strategy has significant limitations as to what we're willing to do and how creative we can be. And creativity, over the years, your creative desire gets greater and greater. And yet, but I think that's important to resist that creativity, because in the essence of it, it's not going to be something worthwhile if it makes your systems less robust, fewer sample size of trades in the past, and more fine-tuning your system to historical market patterns.
Yeah, I mean, I think another way of commenting on this same question, George, is that I truly believe that trend following to a large extent is about finding everything that doesn't work until you find the things that work. And the only way to really do that is with time and experience. And so I think that all the things that we've commented on today is very, very important.
And then it becomes a lifestyle, right? And I think
sure.
The point that Jerry just made is really important, like knowing things that you don't want to do. So, it could very likely have been that with that past month of October, which was a bad month, beam me back 20 years, maybe I would be using the Sunday to test the system and, take it out for a spin and make changes. And then, without a lot of thought, the next Monday go live on a new version of that system. And it's only the experience that allows you to stay the course and accept those months and those periods, just live with them and remain confident for long periods of time that even though you're in a drawdown, fine, we'll come back.
Yeah. Moritz, you get the first go on the next question from George. And the question is, most trend followers say the same things, including the past, may not look like the future. Beyond past performance, which may not look the same in the future, how should one differentiate and select managers?
Ask them questions about risk. How do they philosophically design their systems? How frequently do they change them? Position sizes. I like to focus on risk when I speak to other traders. How exposed are they in certain markets, certain asset classes, longs and shorts, so those type of things. And have they lived through treacherous market environments? How did they handle that? And how have they changed over time?
Sure. No, fine. Jerry, what's your take on this question from George?
I agree with everything Moritz said. I think before I get into that and add a little bit, I would say that my first response would be long-term track records are the best tool to use when selecting managers, and then start probing into these deeper questions of philosophically, do you trade all markets the same way? Do you trade longs and shorts the same way? What do you do when there's material losing periods? How do you handle that? Do you trade smaller? Hint, hint. I once talked to a manager who's very successful, probably still today. I think, yeah, he's still pretty successful. And one of his answers was, I make most of my money. I trade a diversified portfolio, and I make most of my money with stock indexes. So that was a red flag for me, even though I think this firm has been successful. So what my point is, ask these deeper questions about how you're going to handle things. How do you handle things philosophically? I don't have a philosophy. I just go with where the numbers go. That would be another red flag for me. I want to build my system and my rules on the back of my hardcore philosophy, what I believe is right and true in trading, diversification, and but the nuts and bolts, the sample size. No one ever asks about how do you count your sample size, but that's really I think the most important, yet very uninterested by most people question.
Yeah, no, I agree with all of the above, so to speak. But I would add a couple of things. One, George, is that, as said before, I mean, long-term track records are valuable, even though they may not say something directly about the future. They say something, or they say a hell of a lot about how managers have reacted to the past. And as I said earlier on, that I think is really important, making sure that they didn't panic and make substantial changes just out of a result of based on performance. I think that's one question. The other question is, I think that it's important that investors should ask, and I think a manager should be able to explain why they think they are different. I'm not, we obviously don't know exactly what our competitors are doing, but we have all pretty good ideas. And I think it's important that a manager is able to articulate why they believe they're different. And I think as an investor nowadays, I think it's so important to select managers for a portfolio where you can truly, not driven by just numbers, but where you can truly articulate why their individual models are different. I mean, you need to understand the difference of the actual model. You know, is it a volatility breakout? Is it a, price breakout? Is it time series momentum? And how do they interact together? Because otherwise you have a chance of, or risk of just ending up with 3 different managers that end up looking more or less the same. So you need to understand the true difference between them, not just the performance difference that you can see in the rearview mirror. But there's obviously it's a big question. I think it's a great question. I think that's something we all face on a regular basis. And so thanks for that. We've got one more question from George, another interesting one. Several brand names entities are creating trend following indices with low fees to capture the beta from trend following. Why are active managers a better solution? Who wants to go first on this one?
I'd say the same answer I gave to question 1. There probably is going to be a few bells and whistles and advantages of investing in, someone who has been at it a long time. And so, yeah, I think that's, and then I don't think that and honestly, I think that fees are not an issue these days for CTAs to a large degree. So I think that your negotiating skills on finding that right balance between talent and experience and the approach and the fee that makes you feel good, I think it's easy to find. It's not, we're not all holding out for 2 and 20 any longer. So whatever benefit you may pick up on a cheaper version of me, I think it's going to, cost-wise, it's going to be overwhelmed by 35 years of experience and 40 years at done, etc.
Yeah, I agree. And I think the other thing is that, nothing beats looking at the net performance, right? It doesn't really matter whether you charge, 2% or 1% or 0. At the end of the day, we're here to deliver absolute return, net of fees to our clients. You can have a preference for the way fees are charged. And if you think, oh, well, if I only pay, X basis points per year, I'm happy. But, frankly, a lot of the indices of these benchmarks, and I'm not talking about necessarily individual managers who have, different fee options, but a lot of these, benchmarks that has been created or to capture beta, I don't see any evidence of them outperforming the active managers, so to speak. So why would you invest in a product that delivers you less return just because you can, even if you can pay a little bit less? I think investors should strive to get the highest possible net return from their investments and not focus so much. As Jerry said, fees have come down anyway, so it's not like we can charge whatever we feel like. And so that shouldn't be a big concern, and focus on who's delivered the best net performance to the client and start, picking from that universe instead. That would be my view. Moritz, any
agree with everything.
Okay.
First question, I'm very happy that he put the beta in, quote unquote, beta, because I don't consider trend following beta in any way. Now, what those indices have created, I think they've created a good and honest, fair benchmark for CTAs and trend following managers, because, the index is out there, the rules are known, it's transparent. The index, represents and supposed to follow a, say, quote unquote, simple trend following trading strategy, say 200-day moving average, something like that on a large portfolio of markets, long and short. So, if you're a manager out there charging higher fees, then that's a good benchmark for you to beat.
And just because the rules are out there, right? You can find on the internet, I'm sure, rules for how to build a car. It doesn't mean we can all build a BMW.
I agree.
Anyways, good. Well, George, thank you ever so much for your part of today's questions. We've got one more question left, which is from Francois. Francois has also emailed us questions before. This is a different one. I'm pretty sure there's a fairly short answer to this, but we definitely want to address people who take the time and effort to send us their questions. So we will bring it on. Francois says, one quick one for this week. Are there CTAs or hedge funds that are still using point and figure charts? Your thoughts on that approach? Personally, I find it intriguing, and I'm still figuring out how to back test it. Cheers and happy Thanksgiving. So thanks for that, Francois. Jerry, Moritz, point and figure, obviously a technical analysis approach. Are you familiar with anyone out there who uses that?
I have a little story there. So many years back, I was down in Virginia to meet Tom Dorsey. Not sure if that name rings a bell, but he's all about point and figure. And we had a great meeting, a 2 or 3 hour meeting, and talking about lots of things. I really enjoyed that. And but I left the meeting. I was like, this point and figure thing, I just don't get it. It sounded real strange to me. So I sent him a note afterward and said, you have that book out. It's called Point and Figure Charting. I just have it here on my desk. I just pulled it out, and it has a note in there from him, to Moritz. Enjoy reading that. And I started reading it, and I think at some point, don't take that the wrong way, Tom, if you listen to that, but I gave up and focused on other things. So I can't really comment on that, but maybe I should need to reconsider that and read the book again and try to understand it better. Maybe there are some gems in there.
Sure. Sure.
So, but I don't use it.
No. Have you come across anyone using it, Jerry?
Yes, I've come across people, they can't really explain it. It's the opposite of what turns me on. I think complexity and maybe turn some people on and they enjoy it more. But the breakouts, the moving average crossover is there. I think it's okay, everyone out there. It's okay if that's more your style. Don't feel guilty that you haven't made following trends more complex. And I'm not sure how it works. And if anybody can explain it, I have seen situations over the years where people beat themselves up with certain ideas and strategies that are very difficult for anybody to understand. And I too have desired, maybe I can make this more complicated, more moving parts on signal for my signals. But I think the breakouts are incredibly wonderful. But to the degree that it follows trends, it probably has some value.
Sure. No, yeah, absolutely. And I don't have anyone I've come across using that. But with today's technology, who knows? Maybe it can be programmed and be a valid way of doing it. Or as I think I responded to you, Francois, in my email. Some people prefer to combine the systematic approach with some kind of overlay that can't be systematized, and there's nothing really wrong with it. It's not what we do, and it's not necessarily what we believe in. But again, there's nothing wrong or right, and if that's something you can make work for you, then that's great. Performance-wise, CTAs obviously still struggling in the month of November. It's been a tough period, as we've talked about the last few weeks. But as of Thursday evening, I believe, we had the BTOP 50 index down 1.18 for the month, 6.02 for the year. The SocGen CTA index down 1.66 for the month, down 7.72 for the year. SocGen trend index down 2.59 for the month, down 9.74 for the year. The SocGen short-term traders index down 1.5 for the month and down 1.48 for the year. And the Bridge Alternatives, which is a flat fee index, down 1.34 for the year, down 10.28. Sorry, down 1.34 for the month, down 10.28 for the year. Any last thoughts? Any other things that caught your attention this week, Moritz and Jerry?
No, I think we covered it all.
Okay, you're not going to end up with your
happy trading, of course,
hashtag.
but that's always true. It's a truism.
Jerry, anything that you want to share?
Nothing strikes me right now. Yeah, let's just do the next trade. Keep trading.
Yes.
We'll definitely do that. On that note, we will wrap up this week's conversations, which we hope you've enjoyed as much as we enjoy making them for you. And if you felt you get some value of these conversations, please do share them with your own followers, so to speak. And of course, we are always grateful if you would leave us a rating and review on iTunes, because they really do help us spread the word about systematic trading. So from Jerry, Moritz, and me, thanks so much for listening, and we look forward to being back with you next week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.